So, today I'm going to try to explain to you why, as a Bitcoin hodler, you should care about volatility and how you could actually use options to hodl better, to stack more Bitcoin over time without having actually to sell your Bitcoin. I'm actually going to explain to you to use put options to accomplish this. And this sounds potentially paradoxical because put options are generally used to bet on downside. But I'll show you how you can actually be bullish and use put options. But before we get into the options part, don't worry, this is a non-technical talk. And most of the talk will be spent on giving you a good framework as a long-term holder on how to think properly about the role of volatility when you're just buying and holding Bitcoin over time. And the first thing we'll do is we'll play a game. We'll play a coin toss game. Now the rules are very simple. I give you a balanced coin, 50-50 odds of heads or tails. And the returns are asymmetric. I pay you 50 cents on the dollar if it lands heads, and I take 40 cents back if it lands on tails. Now if I ask you whether you would want to play this game, the answer should very clearly be yes. Every time you play, you actually have a 5% edge. You have a 5% expected profit. But now the key question is this. Would you want to play this game multiple rounds in a row when you're reinvesting your wealth each time? And what most people will think intuitively is yes, of course. I win every round, and so multiple rounds means more gains. And we actually have at our booth, we have a little coin toss simulator game where people can try this out. And what they will see is actually counterintuitively that most often people lose. So this is where you plot the game over many different rounds, up to 50. And you see this interesting divergence between two lines. The blue line is the average, and that continues to go up with each round that's played if you simulate it over 1,000 players. But the red line, the median, continues to go down. And what it tells you is that the distribution of how much wealth each player has after each round, it becomes very asymmetric. It becomes very skewed. The average is not what the average player gets. The average player actually gets the median result. What you'll get is that a few players get incredibly lucky and they amass a fortune, whilst most people lose everything over time. So this is the median result if you plot it across the different rounds. And so what you see is that the average player after 50 rounds only has a fraction of their wealth left. And the problem here is not the fact that the expectation disappears somehow. It's that this game is way too volatile. And so you can already picture this if you just play out the possibilities after just 2 rounds. Right? If I have heads 2 times in a row, I already double my capital. But if it's tails 2 times in a row, I already lose 2/3 of my initial investment. And if it's heads then tails, tails then heads, I actually lose a little bit because 1.5 times 0.6 is 0.9. And so that is the key dynamic of this game, is that most people, even though they have edge with every round, they lose their edge to the volatility. How can you then beat the game? Is by not reinvesting your wealth each round, by actually playing it a lot more conservatively and by only investing a small portion of your wealth. Now what we're simulating here is when you position size with 25%. So you keep 75% in cash and you only bet 25% per coin toss. And now you see that the average and the median are nicely tracking together. By basically managing the volatility better, the average player will actually have a positive result. Here you see it steadily grow over time. How did I get that 25% number? It's actually something that in investing is known as Kelly sizing. Kelly sizing is thinking about the odds of going up and down and the volatility of returns, and then it figures out the optimal position size to bet. And so in this game, because of the high level of volatility, the optimal position size is basically only to bet a quarter each round. So now let's connect this game, this coin toss game, to the real world. This is where I'm simulating Bitcoin returns. And for the same expected growth rate, let's say 20% a year, I show you the simulated effect of having an increase in volatility. And then what we realize very quickly is that actually buying and holding Bitcoin is very similar to this coin toss game with full reinvestment. Right? It's like every day Bitcoin is a coin toss. And it has a certain drift, right? It has a certain trend going up. But for that trend, the more it is volatile, the less actually we expect to gain by just buying and holding. And so then the question becomes, is there like a solution very similar to the coin toss game where we sort of started having cash on the side to essentially manage the volatility? Is there a way we can sort of beat the holding game in a similar fashion? And if we think about position sizing similar to the coin toss game, the problem would be that we would be selling at some point, right? Or having always cash on the side when we want to be fully investing in Bitcoin. And I think for most Bitcoiners here, that would not feel comfortable, right? We would either be relying on ourselves, on our skill as traders to sort of sell high and buy low, or we'd always keep a portion of cash on the side, which of course is then where we suffer inflation. And this is actually where put options can come in. Because put options, they provide asymmetric downside protection. A put option is a right to sell at a certain price. At least the contract mimics that payoff. And this is a way to potentially make money when Bitcoin goes down. But then, of course, the issue is it's also a form of insurance. And so it is a contract where we can theoretically, or where we can mimic a sale of a Bitcoin, but there's always this premium that we're paying. So in the end of the day, are we solving something with puts if we just protect our Bitcoin with puts? And the reality is that if you just buy puts over and over without doing anything else, it is insurance, and you actually should expect to lose a little bit of money. It will dampen the volatility of your portfolio, but you won't make money on the put options themselves. But that is actually limiting the role that they should play. The real role that the put options should play is actually the midfield. Now I'm from Belgium, so I use here an example with Kevin De Bruyne. So a good put option is like putting Kevin in your team. And the effect will be that now he can intercept the ball, he can launch a counterattack, and now your attackers have more shots at goal. And that's the real role of these puts. The put options, it's not just the expected payoffs they have. The most important thing about them is actually the timing of when they pay off. Right? It's that they pay off when Bitcoin is suffering from a dip. And at that moment in time, they give you cash to buy more Bitcoin. Whilst it doesn't have that, because it's an asymmetric contract, it doesn't have that the downside that all the alternatives have, which is at some point you need to sell some Bitcoin. Here, this is truly just something that gives you more cash when Bitcoin goes down. In and of itself, that cash is not enough to compensate for all the costs of the puts. But if you can now reinvest that into Bitcoin, and then if you're bullish and you expect that Bitcoin will over time trend up, this is a way to start buying the dips and accumulating more than you would have if you would just have the Bitcoin portfolio without the puts. So this is where I've run this experiment since the start of the year. This is a great showcase of sort of the volatility dampening effect of Bitcoin protected by a put option. The blue line is essentially that. So This is a 100K put. Essentially, what it starts to mimic then as a portfolio is something that that has the downside protection that basically creates a floor of the total value of your Bitcoin and your put option. And you see the Bitcoin outright performance in orange. And all the difference between the blue line and the orange line essentially becomes cash in your portfolio. Now, if you trade this on an exchange like Thalex, the advantage is also that you don't need to sell the puts to actually capture that profit. Everything works with daily settlement of your P&L. So the only thing we require is that when you put some Bitcoin on our exchange, right, that is acting as collateral, and then you can just open put positions against that. And as long as you have enough collateral, you actually never pay for the put option. What we settle every day in your account is the daily P&L of that put option. And so literally, every day that Bitcoin would then go down and the put starts to increase in value, that is just cash. In our case, it's Tether, which you use to settle. That is just a cash amount that builds up and that you could use then at your discretion to buy the dip. And here in this slide, that's exactly what I've done by rolling forward puts across the whole first half of the year. And then in the green line, this is the amount of Bitcoin I was able to buy by reinvesting the cash of the puts above their initial value. All of that cash was just settled on my account, and as soon as it exceeded 5K, I would just automatically start reinvesting that into Bitcoin. And you see in particular that in early March, we had this very sharp dip down to 87K. And that's where in this backtest, I was able to essentially buy 0.15 more Bitcoin. Over the whole 6 months, just by buying these puts, I was able to accumulate 20% more Bitcoin. And so this is where, again, it's important to stress that the puts in themselves, like on average, they expire worthless. And they're always priced by market makers to be slightly too expensive. We call this the volatility risk premium. And basically, you need to think about market makers who sell you these options as manufacturers of risk. Right? They sell you the risk at a certain price, and then they go and hedge that risk. Basically, they manufacture that risk in a different way so that they can earn a spread. And the long story short is that when you buy calls or puts, you should always expect that you pay a little bit too much of a premium relative to the expected profits of the put or the call standalone. But that's okay, right? As long as you don't overpay way too much. And usually overpaying for options means if their volatility price is more than 50%, you should start to be careful. If like right now it's 40%, it usually means it's a good deal. And the reason why it's okay to overpay a little bit for the volatility premium in that option is exactly what you see there, is that ability to buy the dip, to buy 20% more Bitcoin. And then that 20%, when Bitcoin ultimately recovers, that 20% more is effectively where you make the return on those options. And where the whole of it actually becomes a portfolio that beats Bitcoin standalone over time. And that's one of the use cases that really at Thalex we want to encourage. So we're an options exchange. We offer also perpetuals and futures, but really options is our bread and butter. We're also actually partnered with Bitfinex, where if you're a Bitfinex customer, it's very easy to onboard with us and to actually start trading options from your Bitfinex account. Now we know that options are scary for most Bitcoin crowd who's maybe only traded perpetuals or futures and nothing beyond that. So what we also do is to encourage people to try is when you sign up with us, we give you some free collateral. We call them ABCs. And those ABCs you can learn to sort of try out options risk-free. If you lose money on ABCs, we absorb the loss. But if you make profits, then we give you the gains. So it's something that I recommend you try if whatever I said here in the talk sounds like something that's interesting for you to increase your hodl performance. That's most of it. Is there maybe any questions? Sorry? Oh, there's a mic. Right. Is there a mic we can? Yeah. I'll just. Any questions? No. Ah. I thought. Okay. Yeah.
So who's the seller of the option? Is that you, your exchange? Who's the counterparty?
So the counterparty to all these options is usually dedicated market makers. So we, as an exchange, we don't trade against our own customer. But yeah, we have actually a whole host of market makers that are also our investors, and they provide most of the options liquidity. Yeah.
Yes, thank you. Then why would the market maker who sells the option not do the strategy themselves? Because it's profitable, as you say, right? Why would they then take this opportunity cost?
So this is actually a quite technical question that goes into like how market makers work. But really what they do when they sell an option is they take all of the directional risk out of it. It's called delta hedging. So what they would do is if you buy a put option for, let's say, what is called a 30 delta, that's the sensitivity of that option to the price of Bitcoin. So whenever Bitcoin moves by $1, that put option will move by 0.3. And then what actually the market makers do is they don't want to take the risk of Bitcoin going down or up. What they actually do is they then buy a corresponding amount of futures to always hedge dynamically the directional risk of those options. And when they do that, they will sell you at a volatility that is slightly too expensive, and they will, with the hedging, replicate the same risk, but actually at a cheaper cost. So again, it's a risk manufacturer. They sell you an option at what we call implied volatility, which is basically just like taking the price of an option and then expressing it as a volatility parameter. So what they'll do is they sell it to you at 42%, and they maybe hedge it at 39%. And they basically create a differential. And then if you do that with economies of scale, where there's a lot of people buying and selling options from you, you can even lower the hedging cost further. And so actually, this is how with options you can truly have a win-win. Because you basically wanted to use the options to get the directional exposure, and they give it to you by just hedging the directional risk and expressing it as a volatility trade. And you guys can both win. If Bitcoin goes down and you bought the put option, you made money. The market maker who hedged responsibly also made money. Any other questions? Any other questions?
Listen to me, because next to me, thank you very much. Why are you analyzing the strategy of shorting options, which will be the opposite, given the fact that the Bitcoin price usually moves in long bull cycles, like some for this one? Do you consider this in your platform or system that you depicted? Or what's the advantage you can see on this kind of, like, just getting paid instead of paying for protected puts in that case? Yeah.
So one of the beautiful things about options is that you can buy what you need or what you want by selling something you don't think you need. So there's different ways to optimize this strategy where you can lower the cost of the puts. So for instance, you can make it into a put spread where, let's say you buy an 80,000 strike put, but you then sell a 60,000 spread put against it. So you take a put spread and then you lower the net premium. But what you could also do, and this is what every pension funds in equities does, is they sell upside calls, they collect premium, and then they reinvest that premium in puts. And if you do that, you actually get a buy and hold return with a lot lower volatility exposure. And that is sometimes actually a really good idea, especially in a bull market when volatility gets expensive, when everybody's just betting on upside. You can actually just sell those upside calls, buy the puts, and in then the scenario where you really, Bitcoin goes up a lot, nothing prevents you from then saying, okay, I buy a little bit of Bitcoin back higher. But most of the time, actually, the calls will expire worthless because people are always too ambitious. And then the real value of that is you could have essentially a premium neutral strategy of selling calls, buying puts, where you get the put protection effectively for free. Yeah. Exactly. Yeah.
In the long term, it's always your main point to get Bitcoin cheap with this huge cash you accumulate with the productive.
Yeah, and it's literally using the volatility for you, so that without selling your core stack, you just put some Bitcoin as collateral, and then whenever Bitcoin dips, the puts give you the cash so you can buy more, and you don't need to sell your spot. Are we good? Oh.
You just mentioned that like you can also sell an option. Is that a possibility for users of your platform to also sell options, basically almost like peer-to-peer?
Yeah, so we have essentially a fairly advanced option platform where we don't restrict selling options to any user, and we actually dynamically calculate the margin requirements so that we always look at the portfolio of everything combined. And we basically do like P&L shocks, and based on like a certain loss you need to absorb, we define your margin requirement. So it's not on a position basis, but on a portfolio basis, which actually means that if you're selling options naked, we will actually charge you quite a bit of margin because that's dangerous. But when you sell options with Bitcoin as collateral, we will drastically reduce the margin requirement for that. And so actually the margin requirements, when you do it responsibly, you're spreading options or you're hedging options with some collateral, they're actually quite low, and it's fully permitted. Yeah.
So you said you can buy put options, but I think you could in theory also sell call options, which would result kind of in a similar thing. Would you also have this upside that you can then, in the case where Bitcoin drops, then use this extra money to buy Bitcoin?
Yeah, so that's exactly right. So very similar to the put options, if you sell calls and they expire worthless, you just collect the premium, right? You sell them, for instance, for 5K, they expire worthless, that's 5K cash extra on your account. Absolutely.
Do you offer that on your platform as well?
Yeah. And what we also offer is the ability to execute combinations in one trade. So you can do spread trades, you can do what I just explained of like selling the call, buying the put all at the same time, which is really useful because then the margin requirements are immediately reflected for the end result and not what they call lagging, which is sometimes dangerous where you execute one trade but you don't get the next trade done. So we have, yeah, any options trade you can imagine you can actually do on Talex right now, yeah.
In which countries do you operate?
So it's the classic where anywhere outside of certain excluded jurisdictions, we operate. So we can't onboard US customers, we exclude Japan, we exclude, of course, all the typical countries that are on political blacklists. But other than that, if you're European, Asian, Asia-based, basically rest of the world, Latin America, you're always welcome. Yeah.
Thank you very much.
Okay, I think that's my time. Thank you so much.
Secure your BTC Prague 2026 ticket at the lowest possible price now.